Are you past 40 and feeling the pinch when you think about retiring, let alone actually enjoying it? Here's the reality check. The old grind hard and sock away every penny approach simply doesn't deliver anymore. We're living longer lives, inflation is steadily eroding our nest eggs, and traditional pension plans have all but disappeared. That 401k retirement account you've been topping up might not be where you thought it would be. You could still be punching a time clock, not out of passion, but out of necessity. Decades ago, Warren Buffett laid it out. The truly wealthy don't trade hours for dollars. They buy assets that generate cash flow on their own. Today, we're breaking down 8 income-producing assets that ordinary Americans leverage to retire early and build lasting wealth. These are no quick-rich schemes. They're proven vehicles that can transform your financial future, even if you're getting a late start. Watch out for asset number 8. It's built for the digital era and taps into your own expertise for limitless income potential. Let's kick things off with the first game changer. First asset, real estate, the cornerstone of passive income. Real estate isn't just about acquiring property. It's about securing your financial independence. While many see it as complicated or out of reach, savvy investors view real estate as their personal cash printing machine. Here's why it matters. Every month, tenants deposit rent in your account. Every year, the property gains value. And every tax season, you claim deductions. That's 3 income streams from a single investment. Take John in Detroit. Over 6 years, he purchased 3 single-family homes and now collects $3,600 in rent each month, walking away with about $2,000 in positive cash flow. The real power here is leverage. You can control a $200,000 property with just $40,000 down, and your tenants essentially cover the loan through their rent checks. But remember this: location trumps the building itself. Target up-and-coming suburbs with strong job markets and landlord-friendly regulations. For example, in Indianapolis, a $120,000 duplex will rent for about $1,200 to $1,400 a month. You don't have to manage doors and repairs yourself to benefit from real estate. Real estate investment trusts let you own slices of office buildings, hotels, and apartment complexes for just a few $100s. Companies such as Realty Income Corporation distribute monthly dividends and handle all the day-to-day management. Then there are the tax advantages. You can depreciate the structure, deduct mortgage interest, and even defer capital gains taxes with 1031 exchanges when you swap one property for another. It's like the tax code is actively cheering you on to build wealth. But real estate is just the first pillar. Imagine an asset that deposits cash into your account every 3 months, requires 0 upkeep, and has been enriching average Americans for more than a century. Second asset, dividend stocks, your personal paycheck in perpetuity. Picture receiving a check every quarter simply for owning shares of America's most successful companies. That's exactly what dividend stocks deliver. They turn you into a silent partner in profitable businesses without punching a clock. Companies such as Coca-Cola, Johnson & Johnson, and Procter & Gamble have increased their dividends for more than 25 years straight. These so-called dividend aristocrats are so dependable that many retirees treat them like bond alternatives with upside potential. Linda in Ohio invested $100,000 into dividend exchange-traded funds over a 5-year span and now pulls in $4,200 each year, rain or shine in the market. The real magic unfolds when you reinvest those payouts. By automatically plowing dividends back into new shares, you create a compounding snowball. A $500 monthly commitment to a dividend ETF, such as SCHD, could grow to over $162,000 in 15 years, then yield more than $5,000 annually in dividends. And here's the key insight most people overlook. Dividend growth outscores high initial yields. A company paying 3% today, but boosting dividends by 8% per year, will eventually outpace a business stuck at a 6% payout with no growth. Microsoft started out paying almost no dividends, but now its shareholders have become millionaires thanks to those payouts on their initial stakes. The real beauty of dividend shares is their liquidity. You can exit at any time when the market is open. They tend to increase with inflation more than bonds do, and over the long haul, they typically outpace inflation better than a bank savings account. If reliable dividends are great, nothing tops the assurance you get from U.S. Treasury securities. When you need to sleep at night without fretting over market swings, these government IOUs are unbeatable. They're backed by the full faith and credit of the United States, the world's most dependable borrower. Take Robert in New Jersey, for example. He shifted $250,000 from volatile equities into Treasury notes and now collects about $10,500 every year, calling it his peace-of-mind paycheck. At age 62, he says that steady safety matters more than chasing higher returns. Treasury bills mature in less than 1 year, Treasury notes between 2 and 10 years, and Treasury bonds from 22 to 30 years. Right now, you can lock in yields of around 4 to 5%, which leaves most savings accounts and certificates of deposit in the dust. On top of that, the interest is exempt from state and local taxes, especially powerful if you live in a high-tax jurisdiction. Laddering these securities by buying staggered maturities creates a schedule of returning principal every few months, letting you reinvest or spend as needed while adjusting to changing interest rates. Inflation-protected Treasury securities deserve a shout-out too. These bonds automatically tweak their value with inflation and currently pay more than 4%. You can acquire up to $10,000 worth per person each year, making them ideal for conservative folks worried about rising living costs. Now imagine holding tiny shares of America's biggest companies without handpicking any single stock. That's the power of index funds and exchange-traded funds, Warren Buffett's go-to advice for everyday investors. By buying an S&P 500 index fund, you immediately own a slice of Apple, Microsoft, Amazon, Google, and hundreds of others, with zero stock picking required. Consider Sharon from Colorado. She funnels $600 a month into a total market ETF, and after 12 years has built a stake worth over $145,000. Her strategy? Automate each deposit and forget about the day-to-day noise. This approach offers instant diversification. If one company stumbles, the rest hold everything up, and comes with rock-bottom fees, sometimes as low as 0.03% annually. Compare that to actively managed funds charging 1 to 2%, and you keep far more of your gains over the long run. Dollar-cost averaging makes these funds even more attractive for somebody with a 9-to-5. By investing the same amount each month, no matter where markets stand, you buy more shares when prices are low and fewer when they're high, smoothing out the ride and steadily growing your nest egg. When prices decline, you invest more, averaging out volatility and typically outpacing market timing attempts. But imagine a different route. Build something once and collect payments indefinitely. Asset number 5 is all about turning your know-how into a revenue engine, royalties and licensing. Create a product a single time and keep cashing checks for years or even decades. Royalties represent the ultimate in passive income. Once your work is out there, payments continue without extra effort. For instance, Mark in Arizona turned his consulting expertise into online courses and now draws $800 a month from content he developed 2 years ago. The true power of royalties lies in scalability. Whether one person or 1 million people buy your course, read your book, or license your photos, your workload remains unchanged. It's like owning a vending machine that never empties. You don't need to be a best-selling author or a chart-topping musician. Ordinary people earn royalties from electronic books on Amazon, stock images on Shutterstock, video lessons on e-learning sites, and even by licensing simple design templates. A retired nurse, for example, created a family care guide priced at $15 and now pockets $500 each month. The key is solving problems you already understand. Decades of on-the-job experience hold insights others would pay to access. That training manual you drafted, the processes you perfected, the expertise you've accumulated, all can become royalty-generating assets. Self-publishing, course platforms, and audio marketplaces handle hosting, payments, and distribution. You focus on crafting valuable content. They take care of the rest. Some top creators eventually sell their entire catalog for as much as 20 to 40 times their annual earnings. While royalties can build impressive income streams, they don't ease the biggest retirement worry: outliving your savings. Enter asset number 6, annuities, or income you cannot outlive. Annuities may sound dull, but they conquer the fear of running out of money before life ends. Susan in Virginia used $120,000 to purchase an immediate annuity, which now delivers $560 every month for the rest of her life, essentially creating her own pension. Think of annuities as the flip side of life insurance. With life insurance, you pay premiums hoping never to claim. With an annuity, you pay a lump sum knowing you'll receive payments as long as you live. The insurer bears the longevity risk, not you. Fixed annuities guarantee a set return, while indexed annuities link gains to market performance with downside protection. If the Standard & Poor's 500 index rises, you share in the gains. If it falls, you're shielded from losses. It's like enjoying stock market upside with the safety of government bonds. The longer you wait to start, the higher your payout. A 60-year-old might earn $500 a month on a $100,000 investment, while a 70-year-old could receive $700 for the same amount. Insurers bet on life expectancy, so delaying boosts your returns. Joint life options cover both spouses, ensuring the survivor continues to receive income. Inflation-adjusted riders protect your purchasing power over decades. You can customize features to match your retirement goals precisely. If you'd rather skip building from scratch, asset number 7 offers a proven blueprint. Buying an established small business or franchise that's already succeeded hundreds or thousands of times. Franchises bring a distinct advantage: a battle-tested blueprint complete with training, ongoing support, and instant brand recognition. Take Eric in North Carolina. He injected $170,000 into a pet care franchise, hired a capable manager, and today pockets about $5,500 each month by overseeing operations for just 5 to 10 hours per week. With franchising, you skip much of the trial and error of starting from scratch. You're buying into a system that's already proven itself, with detailed procedures, ready-made marketing assets, and continuous guidance. Think of it as business ownership with built-in training wheels. For anyone over 40 looking to stay semi-hands-off, these models shine. You provide the capital and big-picture direction, while your management team runs day-to-day tasks. Service-focused franchises, cleaning services, lawn care, tutoring, tend to demand lower upfront costs, yet still deliver strong returns. Thanks to government-backed loans, you can often finance up to 90% of startup expenses, since lenders regard franchises as far less risky than an independent venture. You can even tap retirement savings penalty-free through rollover programs. The secret is to treat your franchise like a true asset, not a 9-to-5 job. Document every routine, train your staff thoroughly, and build systems that hum along without your constant input. Once the business thrives on its own, it becomes an attractive acquisition target, often selling for 3 to 5 times its annual earnings. But in today's digital era, there's an even more potent opportunity than running a physical outlet. The eighth asset unleashes worldwide reach straight from your kitchen table. Digital assets are the next frontier of wealth creation. Online properties that earn revenue around the clock, with no inventory or geographic limits. Consider Denise in Florida. She launched a container gardening website paired with an ebook and now brings in about $100,000 each month from a largely automated setup. The beauty of digital assets is true scalability. Whether 10 people or 10,000 drop by, your operating costs barely budge. A focused blog on retirement planning, monetized through affiliate partnerships and ad placements, can net thousands monthly once it gains traction. You have two main routes: build from scratch, low initial cash outlay, but more time, or purchase established profit-generating sites for immediate cash flow. Marketplaces list digital businesses selling for 20 to 40 times their monthly earnings, making them compelling investments. Entry hurdles are minimal. Hosting a WordPress blog runs around $100 a year. Platforms for online courses handle payments and delivery automatically. Starting a YouTube channel only requires a smartphone, yet some creators pull in 6 figures annually. The key is solving a clear problem for a defined audience. Your expertise, hobbies, or life lessons all carry value people will pay for. Stay consistent with content and layer in multiple monetization streams. 8 assets for financial freedom. These 8 asset classes, real estate, dividend stocks, Treasury securities, index funds, royalties, annuities, franchises, and digital properties, offer proven paths to lasting wealth. Some deliver reliable income, others fuel growth, ensure safety, or offer boundless scale. High net worth individuals don't bank on a single source. They blend these assets into a diversified portfolio that pays them around the clock. Begin with the one that fires you up, matches your skill set, or suits your current financial position. Then, as your capital and expertise expand, layer in the others. True freedom isn't about grinding harder or chasing a bigger paycheck. It's about putting your money to work as hard as you do. These 8 assets are your step-by-step guide to getting there. I read every comment you send, and your insights drive me to deliver even stronger, more valuable content for you.